Welcome to This Explainer. Today, we're unpacking Walt Disney's fiscal Q3 2026 earnings. It's August 5th, 2026, and with new CEO Josh D'Amaro at the helm, the numbers we just got are, well, they're a classic mixed bag. We're going to look directly at the data today to see if this is finally the turning point investors have been waiting for, or if the structural headwinds are just too strong to ignore.
Okay, let's just dive right into this massive number. Because despite some misses, Disney is aggressively doubling down on a 12% adjusted earnings growth strategy for fiscal 2026, and they're even projecting double digits for 2027. Listen, this isn't just some hopeful guess. It is the absolute core blueprint of their massive transformation from a traditional media giant into a fully diversified digital ecosystem.
So, to see how they actually plan to pull off this 12% growth strategy, here is our roadmap for this explainer. 1. The 12% growth target. 2. Twin engines powering growth. 3. The flywheel in action. 4. 3 major strategic moves. 5. Headwinds threatening the plan. And 6. The new ecosystem vision. Let's get right into it.
All right, Section 1, the 12% growth target and that Q3 earnings beat. Let's start with the headline numbers that actually drove a 4% pre-market stock pop today. Now, check out the stark contrast here. On the left, Disney's adjusted earnings per share came in at a really strong $2.06, comfortably beating Wall Street's expectation of $1.86. That is a 28% increase year over year. But look on the right. Under standard GAAP accounting, net income was only $1.51 per share. That's a huge drop from $2.92 a year ago. So what exactly is going on with that huge gap? Well, the GAAP number was simply dragged down by massive one-time tax benefits that were included in last year's quarter. When you strip that away, the adjusted basis shows a story of highly solid growth, which is exactly why the market reacted so positively this morning.
Moving right along to Section 2, twin engines powering growth, specifically parks and streaming. Because behind that earnings beat, Disney isn't just relying on magic. They are relying on two very specific, heavy-lifting engines to power this entire turnaround. This brilliantly illustrates the steady foundation of Disney's first engine, the experiences segment. We're talking theme parks and cruises here. They pulled in nearly $10 billion in revenue and over $3 billion in profit. And what's even more impressive is that domestic park attendance actually rose 3%, with per capita spending up 4%. To put that into perspective, you have to compare it directly to their Orlando rival, Comcast Universal Parks. Comcast actually reported lower attendance in this exact same period, citing weak consumer sentiment and travel costs. So Disney's parks are really bucking the broader industry trend right now.
But here is the real turnaround story. While parks are the foundation, streaming is the growth engine. Disney's entertainment streaming, which combines Disney Plus and Hulu, has officially flipped from burning literal billions in cash to generating a combined profit of $700 million. Revenue grew 11% to over $5.5 billion, and that's driven by more subscribers, price hikes, and way better ad sales. Think about that for a second. They are now officially making more money from streaming than from traditional linear TV. That's a massive shift.
And new CEO Josh D'Amaro is already pointing straight to the future. He noted that they are transforming Disney Plus into a comprehensive membership ecosystem by spring 2027. This isn't just about watching movies on a Saturday night anymore. It's about building a digital centerpiece that touches literally every aspect of your relationship with the brand.
Which leads us to Section 3, the flywheel in action and synergy across channels. To really grasp how this unique business model fuels their 12% growth strategy, we have to look at the ultimate case study.
Look at the absolute ripple effect of Toy Story 5. It didn't just cross $1 billion at the global box office. That theatrical release basically acted as a massive global advertisement, pushing the Toy Story franchise past 2 billion hours streamed on Disney+. And because everyone was watching it, they started buying it. Consumer products revenue hit $1.1 billion this quarter. That marks its strongest year-over-year growth in 5 years. It's an incredible flywheel. The shows you stream and the movies you watch are feeding directly into merchandise and parks.
Let's look at how they keep this going in Section 4, 3 major strategic moves and key announcements. Beyond the quarterly numbers, leadership just dropped a proactive blueprint designed to aggressively secure that growth plan.
Walking through this plan, step 1 is aggressive capital return. D'Amaro is raising their share buyback target to a minimum of $9 billion. And they're partly funding this by selling their 50% stake in A+E Global Media to Hearst for $1.2 billion. Step 2 is a massive pivot to capture Gen Z through a global content sharing partnership with TikTok. And Step 3 is an internal reorganization. They are moving the entire consumer products business out of the experiences segment and directly into the entertainment division, so it sits right next to the creative studios like Pixar and Marvel.
Actually, let's zoom in on that TikTok deal for a second, because it introduces something called verts. Remember a few months ago when Disney's billion-dollar deal with OpenAI completely fell apart after the Sora platform was shut down? Well, this is their pivot. Under this first-of-its-kind deal, TikTok creators get access to Disney's biggest brands, and the resulting short-form videos will seamlessly blend directly onto the Disney Plus platform via verts. They are actively integrating social scrolling directly into their premium streaming app.
Of course, it's not all fairy tales. Section 5, Headwinds Threatening the Plan. The 12% growth strategy is definitely ambitious, but for total objectivity, we absolutely have to acknowledge the very real, structural challenges threatening to derail it. Take a look at this jarring number. That is a severe 17% drop in operating income for Disney's sports segment, primarily ESPN. Despite revenue being up slightly, profits tumbled down to $858 million. Why? Well, it's a combination of early NBA playoff series ending in 4-game sweeps, which, means way fewer broadcast windows for ads, combined with some really expensive network carriage disputes. Linear sports television remains a highly volatile piece of their portfolio.
Furthermore, there's a bit of a disconnect right now between Disney's internal confidence and Wall Street's expectations. Disney issued a full-year 2026 earnings per share guidance of approximately $6.64, but the analyst consensus was sitting higher at $6.83. This gap, this slight miss on future guidance, creates a potential overhang for the stock. It makes investors wonder if the turnaround is happening quite fast enough.
And when you zoom out to the stock's long-term timeline, you instantly see why investors are so anxious. Before today's earnings pop, the stock had declined nearly 16% over the past year. Now sure, there is a positive 15% return if you look at a 3-year window, but the 5-year picture, that shows a steep 42.8% decline. Add in the fact that rivals are really putting on the pressure, like Sony's new Spider-Man Brand New Day setting box office records right up against Disney's own Marvel slate, and it's super clear the competitive environment is incredibly fierce.
Finally, Section 6, the new ecosystem vision and the future of Disney. This brings us to the ultimate synthesis of what we are looking at today, Disney's ongoing transformation from a traditional legacy media company into a modern digital ecosystem.
The data clearly shows a company in massive motion. Streaming is finally profitable. Theme parks are outperforming their peers, and they're executing massive buybacks alongside innovative TikTok integrations. But the legacy drag of traditional sports networks and mixed box office results are heavy anchors. As you process all the data and strategies we've covered in this explainer, ask yourself, is the momentum in streaming and parks enough to outrun those legacy challenges? And will this 12% growth strategy ultimately be enough to revitalize the magic for investors? Keep that in mind as we watch how this all plays out in the coming quarters.